for another video. So this is going to be another Reddit DD read aloud. This is a post that it didn't blow up too much on Superstonk, which is the official, I guess, official Reddit page for GameStop now. I'm not sure if it got too much traction, but I thought it was very interesting. This user, his name is Swissy Cheesy. Very interesting. They put a lot of a lot of different theories together. The post isn't too long, so let's just get into it, guys. Just a reminder, please leave your thoughts on the DD and on this video in the comments below. I will be responding. I would love to have a conversation about it. Please like the video. If you can support the channel, it would mean a lot. And definitely subscribe to the channel. I am going to be doing a small crypto giveaways at 50 and at 100 subscribers. So if that is something that interests you, definitely hit that subscribe button. We are coming up on those, so they'll be happening sooner than we expect. But yeah, guys, let's just jump right into it. So again, the username is Swissy Cheesy, and the title is The Beginning of the End. So this post is simply putting few facts together and my own interpretation of what it means in the squeeze to come. This is not financial advice, just the opinion of a humble ape with a couple of wrinkles. Mods, please review and flag as appropriate. Da, 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 da. In this post, I'm going to cover what is happening with the VIX, what is happening with the 10-year Treasury note, its link to inflation, and why all this is the beginning of the end of the GME saga. I believe the squeeze is getting closer. No dates provided if that's what you're after, sorry. The VIX. The VIX measures the volatility in the market, or how mad people think things are going to get. Since the beginning of the week, the VIX is up 40%. And he does provide a link to this here. So if we look in the past 5 days, yeah, up about that. I mean, this is not a 7-day chart, but again, it's up about 40% in the past 7 days. So this reflects that the market is expecting a lot of uncertainty with more radical price movements. You can see in this post here that even the smart money in halftime doesn't know whether to buy industrial or sell industrials. People do not know what they need to do, so increased uncertainty, hence increased volatility. In that video, they even talk about margin calls, adding nervousness into the system, but I will cover this a bit later. Remember a few weeks back, someone bought 250,000 contracts of 25.40 July call spread on the VIX, but that was a $40 million bet that the market would go crazy. At the time, it was speculated that this bet would be Dr. Burry himself, would fit well on his way of investing just before closing his Twitter account. We will never know for sure, but someone with big pockets believes the market is going to go nuts. In the last couple of days, there has been a lot of unusual activity in the call options for the VIX, suggesting things are not going to get any more quiet, but even more volatile. P.S. I own X contracts of that 25.40 call to, printing over 40%, is that right? Net, the market is expecting a lot of volatility. The 10-year note. Here, you may need to grow a wrinkle. I hope I can explain it like I'm 5. That's what Eli 5. Explain it like I'm 5. The 10-year is basically the risk-free asset against which any investment decision is made. I can invest in something with increased risk versus doing nothing, and that risk premium needs to be worth it compared to the risk-free asset, meaning the 10-year or any government bond like 30-year or 5-year. Since the beginning of the week, the 10-year note has lost 7% of its value. The 5 years lost 13%. That means the 10-year interest rate has gone up from 1.6% to 1.7%. The higher the interest rate, the lower the bond price, and as cash flows over time, they are brought to today's value with a higher discount rate. Interest rates go up with 3 main drivers: inflation, how risk-free is the risk asset itself, and the Fed. Risk-free, there is no such thing as a risk-free asset. Any security would have 2 components of risk: systemic risk and specific risk. Very often in those useless congressional hearings, they talk about systemic risk. Hedge funds represent a systemic risk to the market. Banks need to be well capitalized to avoid systemic risk. Blah, blah, blah. Systemic risk is the risk of the system going to shit, the economy to collapse altogether. In other words, 2008. The fact that the 10-year note premium interest rate is going up is a reflection of increased risk in the system. If risk-free asset becomes riskier, then I want more return for my investment, obviously. This links with the explosion of VIX. People perceive more risk in the system because of increased volatility. VIX goes up, interest rates go up. Inflation. Inflation in macroeconomics is closely linked to interest rates. There are several types of inflation, but to keep it simple, If the amount of goods and service is the same in an economy, but there is much more dollars in circulation, then all goods and service will become much more expensive by simple supply and demand. A controlled inflation is good for an economy to grow. Too much inflation dilutes people's buying power and overall economy competitiveness in the international markets. High inflation countries see their currency devaluate. When inflation goes up, then your interest rates go up. A savings in your bank account at the reference interest rate should allow you to keep buying the same goods in a year time than today. How are your steamies doing? Over the last year, the U.S. has created 30% of its debt, meaning it has put a lot more dollars in the economy to recover from the pandemic, so naturally inflation is increasing. Look at the evolution of any commodity in the recent weeks. Last week, the announcement came of inflation being at 4.2%, which is twice what healthy inflation of around 2% would be. Enter the Fed. The Fed mandate is to drive full employment and maintain stable prices. So basically, sells or buys bonds, issues or buy debt back to put or remove liquidity in the system to ensure the economy can create growth, jobs, and inflation is controlled. Last year, it pumped a lot of liquidity for the economy not to collapse. So effectively, Fed manipulates interest rates to deliver on its mandate. Inflation is a major risk for the Fed. If inflation spikes, the Fed will remove liquidity by selling bonds, and if inflation is low, it will buy bonds back and put money in the system. In the current context, the Fed continues to buy debt to fuel the economy with liquidity and manipulates the interest rates to avoid inflation. The problem is inflation is growing beyond where it should be. So sooner or later, the Fed will have to stop buying bonds and actually sell bonds. Demand and supply. Interest rates will go up, and more importantly for GameStop, bonds prices will go down. I am sure you've read Adabit's post of the Everything Short. There is a very important chart there about the collateral used in the repo market, where 67% of the collateral used for margin is U.S. Treasuries, and I'm assuming most of it is in the 10-year or the 5-year. Also, here is a very interesting chart published by the WSJ, the Wall Street Journal, on how margin debt works, and more importantly, how balances and margin accounts are. The number $800 billion. Let's put it all together, shall we? There are $800 billion in margin accounts. 67% of that uses U.S. Treasuries as collateral. U.S. Treasuries went down this week by 7%, assuming all 10-year, if combo of 5-year and 10 years, it would be even more. So simple math, 800 times 67% times 7% equals 37 billion. That is the amount, give or take a few billions, that the banks have asked or are asking investors to put back to maintain their margin accounts. Margin call hedges. So what do they need to do? Sell their long positions to cover that margin call. So what would happen to the markets? They will drop, which is what has been happening this week to the S&P down 4%, NASDAQ down 5%, with companies like Tesla losing 13% this week and the ARK fund losing 8%. And here is where the domino starts. Not only hedgies need to put 7% more cash to cover their margin account, their long positions are also dropping 5% on average, assuming, which in turn means the banks will ask for more collateral since the systemic risk is increasing. The VIX. The current collateral is losing value, increased rate for the 10-year, and the value of their holding is declining. Add to the fact that companies' valuations, so the multiple of their sales or cash flows which reflect their market price, is based on the risk-free asset for comparison. The higher the 10-year interest rate, the higher the premium needed for riskier assets. Think of tech stocks with little profits and little cash flow today, but higher expectations for the future. So the more the valuation of the company, its price, is overvalued when the 10-year goes up, this will drive further corrections in the market. The DTCC knows this, hence why I believe they have been in a hurry to pass a lot of rules to protect themselves and make a liquidity test last month. Normally, they only do that once a year, yet today they will do another one. Well, that was yesterday. They are nervous, so back to the VIX. There starts a domino for GameStop. As hedgies get margin called, sell long assets, stock price goes down, their remaining assets lose value, and one or many will go belly up. Banks would have to liquidate that fund Archegos style, closing their positions, making the price in the market to further drop, which increases the margin requirements for the remaining hedge funds. It's a vicious cycle. The weaker hedge funds will start falling, considering the large amount of shorts in GameStop, with married puts, so shorts made out of thin air. The moment one hedge fund shorts GameStop and gets liquidated, it will trigger the buying pressure in the stock. That will be the catalyst we need. Worth pointing, AMC and GameStop are in the same boat. Not sure if we have done the same level of diligence on AMC on how the FTDs are being hidden, but clearly their price action is very similar. And so their cost to borrow back in January with the first mini squeeze. Look at the cost to borrow of AMC today. It is up to 80%, similar to the level of January. We do not see the same in GameStop because of all the effery going on in the married puts and the dark pools. But it is clearly an indication that something was about to go boom. And if AMC goes to the moon soon after or at the same time, GameStop will do the same. We are up for a ride, and I sense the takeoff is going to get closer. The TLDR summary: volatility is exploding, the market is nervous, interest rates are increasing because of market inflation and increased volatility. Bonds are losing value on interest rate increasing, collaterals are worthless, margin calls are happening. It is only a matter of time for the weaker hedge funds to go belly up and trigger the mother of all short squeezes. So yeah, guys, very interesting post here by Swissy Cheese. I thought it was cool just to bring, the idea about the VIX going up, the volatility going up overall in the market. I think that definitely applies here to GameStop. GameStop has been one of the most volatile stocks in the market as of recent. And, usually GameStop spikes correlate with the VIX going up. So, I think we're going to see some action soon, guys. Again, I am holding currently at almost 100 shares of GameStop. So I'm not all in, but almost all in. So yeah, guys, please leave your thoughts on this video down below. I'm going to be doing more read alouds. I don't know if you noticed, but in that video I actually opened the everything short here. I am going to be doing a video on that. It's a very long post. That's kind of why I haven't done it yet. I've just been procrastinating on that. But I am going to be doing it very soon. It's a very important piece of content regarding GameStop, and I want to get that info out to you guys. So yeah, any support on the channel is much appreciated. Please leave a like on the video. Please leave your thoughts in the comments below. Definitely subscribe to the channel. I'm going to be doing giveaways, very soon, crypto giveaways. Depending on the amount of attention my channel gets, I'm going to be doing more and more giveaways, because I want this channel to grow just so I can get information out to people that need it, so thanks guys for watching, and look out for more videos. Enjoy the rest of your weekend, and I'll catch you in the next one. Thanks.